Barry, I just want to start with the year-end forecast. You're in a group where you're not that bullish on the index. On the index, you're looking for, what, 3,800, I believe, coming into this year. You're in there with Citi and Bank of America as well. Not everyone is bulled up on this market, and I think we have to be upfront about that. We're looking for a boom in the economy, but not everybody is bulled up on the S&P 500. Barry, why did you turn cautious, even more so, I think, at the end of January?
I do think this year will be a tale of two halves. On the one hand, you've got the probable normalization, a little bit more so in yields as the year goes on. First half is seasonally strong. That's just something that's existed for a very long time. Our second half estimates for earnings are below the street. I don't think over 40% growth year over year is going to happen. We are in the high 20s on our earnings growth forecast, and it comes out of the back half. The fiscal comparisons as you look ahead to 2022 are going to be very difficult because of all the money spent this year. It's going to be a drag next year because the money won't be there at the same degree. And then I'm very concerned about some of the emerging geopolitical risks. I think what's going on with Iran and what's going on with Ukraine is something that by the summer, early fall could actually come back.
Let's strip out the geopolitics for now so we can focus on the earnings story in the here and now and the dynamics here in the United States. We'll get to that in just a moment, Barry. You're focusing on real yields in America. And I want to understand from your perspective where you see them evolving, how you see them evolving in the coming quarters, the coming months, and what it means for your equity market call as well.
One of the concerns I've always had about a TINA, there is no alternative to equities in a low bond yield environment argument, is that yields, let's just take the 10-year tips, at minus 65 or so, basis points is about 225 basis points below its long-term average. Now, I understand all the factors of why that is, but you're talking about a huge hit to equity risk premium if we ever receive any sort of normalization of yields. And since the objective here on this truly unprecedented amount of fiscal stimulus and monetary is to reflate and generate growth, what if they succeed? There's at least a high probability of that. And if that happens, then valuations are very exposed to this environment.
Barry, some people might sit here and say breadth is looking really good, participation is better. Others might point to volume. Volume's been lighter over the last week, Barry. I think we had the lowest volume day of the year last week. What do you make of that, Barry? The lack of volume going into a really important time for this economy when we're about to see the data we've been anticipating for months.
The bulled-up investor right now, seeing speculative bubbles everywhere, from digital art, SPACs, to some of the strength in companies with no earnings whatsoever, that's got to give some people pause. And I think that there's a reasonable expectation that we should at least wait a while after this rally that has ensued due to low yields. At least wait, and that might be positioning, waiting for the earnings to come through. And as I said, I think the earnings are not going to be quite as strong as the street expects.